Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier Mayer Research, LLC, the providers of Investors Monitor, investorsmonitor.com, and our individual investor service, Frazier's Strategic Allocator. Well, we're recording this week's internet TV show on Friday, December 2nd at around 12:30 in the afternoon. And we, in general, had another fairly positive week, I guess, in the U.S. stock market. Not in the bond market. I hope none of you hold a lot of money in bonds, because bonds have really taken a hit over the past few weeks with yields on both short, intermediate term, and long-term bonds rising substantially, and expectations that the U.S. economy is going to improve substantially during the year ahead. And as you know, I expect that to happen, and I was very confident that if Donald Trump were elected as the next U.S. president, as of course he has been, that the U.S. economy would grow at a much faster pace during the year ahead, and really over the next at least 12 to 18 months. And that's assuming that the tax proposals and infrastructure spending proposal that Trump has made will be enacted. And I'm very, very confident that those proposals will be enacted by the U.S. Congress. And obviously, there's other people thinking the same way that I'm thinking, or stocks would not have moved higher after Trump was elected, and interest rates would not have moved higher if those people were not thinking the same thing. So these are really positive developments. And as I discussed in our written weekly commentary, we got even more positive news this past week regarding both the U.S. economy as well as the Eurozone and Japan's economies. So the outlook's getting better and better, and I am 100% confident, and I'm rarely that confident, that the year 2017 is going to be a very good year for stocks. So you're probably thinking, or you might be thinking, well, why haven't I advise you to increase your allocations to stocks if that's the case? And well, as I wrote about in the past couple of weekly commentaries, and I spoke about in our weekly internet TV show, it's because my experience and research indicates that stocks have moved up too quickly, that most stocks are trading at extended levels. But we don't want to go in and potentially buy near the highs if we might have a decent pullback, which I think we're going to have. And that's why I'm holding off. And I'm not really holding off to try to get you into stocks at exactly the right time and exactly the right price. I mean, that would be a foolish endeavor. That rarely happens, that one's lucky enough to get in at exactly the right time and the right price. Quite the contrary. My goal, as it always is to manage risk. And, if stocks do move up to what appear to be extended levels, then our risk is increased, that if we buy at those levels, that we might incur some downturns over the ensuing weeks. And you never know what can happen in the future. So what if we did get those downturns, and then some big negative news came out of nowhere, which that's always possible. So we always want to manage our risk. We don't want to be chasing after stocks. We want to be patient. And I know that we saw some signs during this past week that lead me to think even more so that the pullback that I've been expecting is now underway. For example, if we look at the trading action in the U.S. stock market, as I have done, we'll find that during Wednesday and Thursday of this past week that both the S&P 500 index and the NASDAQ Composite Index moved lower on increasing trading volume. And that's especially true for the NASDAQ, which pulled back fairly sharply on a big spike in trading volume on Wednesday and Thursday of this past week. And what's that telling us? It's telling us that active traders also think that stocks are trading at extended levels and they're taking some profits. Well, this is a good thing. Let me look at my notes here real quick. I don't want to miss something. Yeah, I don't have a I don't know what those things are called, teleprompter or scripts. I don't read off scripts to do these shows. I just tell you what I'm thinking in a straightforward manner. I don't need to script these out, but let me look at some notes here. Oh, okay. Well, here's another important note regarding this past week's trading action in the U.S. stock market. The New York Stock Exchange cumulative advanced decline line, for those of you that might not be familiar with that, that's the number of stocks trading on the New York Stock Exchange that trade on the New York Stock Exchange that rose in price on any given day, less the number that moved lower in price on any given day, and then cumulatively over a certain period of time. And so the cumulative AD line trended lower throughout the week. And also the number of New York Stock Exchange traded stocks that are trading above their 200-day moving average also trended lower throughout the week. So these are very reliable short-term indicators. Not really indicators, they're revealers. They are so-called technical indicators that give us a good read on what's actually going on in the stock market. And based on that trading action, my thinking continues to be that we're going to see stocks continue to pull back, stocks in general, over the next week to 2 weeks. And as I said in the video that I recorded on November 22nd, my thinking is we might see stocks fall sharply towards the middle of this month after the Federal Reserve has its latest meeting on monetary policy on December 13th and 14th. And that's because, a lot of individual investors and financial market participants, whether they're investors, traders, or speculators, are regularly led to believe by the mass media that interest rate hikes are a really bad thing, that stocks always move lower when the Federal Reserve raised its short-term overnight lending rate, the target Fed funds rate, and when longer-term interest rates also move higher. And I heard someone on one of the major broadcast financial shows that supposedly is an expert in macroeconomic factors and developments that affect the stock market. That's exactly, I wish I had her quote. She said almost exactly that, stocks generally do not do well in a rising interest rate environment. And unfortunately, a lot of people that hear those types of comments, they believe it. They figure, well, okay, was this person saying it must be true? Well, the fact of the matter is, the person who said that is wrong. So she either just doesn't know what she's talking about or she's lying. It's one of the two. Because as I showed those of you that bothered to watch that really long video that I did a couple of weeks ago, where I showed a lot of charts regarding inflation and interest rates, generally speaking, historically, since, at least the 1950s, I've gone back to, I think I went back further than that. Generally speaking, stock prices in general, as measured by the major stock market indices, tend to trend higher during early stages of interest rate increases. And why is that the case? It's the case because interest rates generally start to move up only during periods when economic conditions are improving and when the outlook for any given country's pace of economic growth improves. That's when, so this is not a bad thing. It's only a bad thing for stocks when we get a lot of inflationary pressures and when inflation rates rise to a very high level. And there's nothing to indicate, absolutely nothing to indicate, that inflation rates are going to rise at a high level for at least another 12 to 18 months. So what I'm thinking, and which would be fantastic, I would like to see this very modest thus far pullback in the U.S. major stock market indices continue over the next couple of weeks. And I would like to see short-term traders and speculators, and unfortunately long-term investors too, individuals who listen to these so-called experts that I just mentioned a few minutes ago, who listen to them and believe that rising rates are a bad thing for stocks. That would be fantastic. I'd love to see that happen after the Fed meets on the 13th and the 14th. And I'm also convinced 100%, not from an emotional perspective, but based on research, that the Fed's going to it's going to hike its short-term overnight lending rate, the Fed's fund rate, on December 14th. So great, let's have a pullback. That'd be fantastic, because that will allow us to go in and buy some stocks at some sensible prices, not at these inflated levels at which they traded over the past couple of weeks. Look at my notes one more time here. I think I'm going to wrap it up there. Now, one more thing, let me say. Now, let's say we don't get much more of a pullback. And let's say that instead that the major stock market indices were to move sharply higher on a big increase in trading volume on any given day. Well, if that were to occur, I'll probably also advise you in that type of environment to go in and allocate a lot of your financial market assets to these stocks, exchange-traded funds, and exchange-traded notes, ETFs and ETNs, that I mentioned in our monthly investment journal. Because we want to see one or two things. We want to see stocks pull back to more sensible levels to hold at some key price support levels on a declining trading volume. Why is that the case? Because if stocks are pulling back with lower and lower trading volume, that's telling you that most people are staying in stocks, where that trading volume would be high. And so if they move back on decreasing trading volume and hold near some key price support levels, that's where we want to go in and buy. That's where our risk is lessened substantially. In contrast, if stocks were to move up sharply on any given day, sharply higher, on a big increase in volume, that's telling you that now a lot of these short-term active traders, as well as longer-term speculators and longer-term oriented hedge fund managers are getting really very, very confident that stocks are going to continue to trend substantially higher. So we want to go in not when stocks have been trading in kind of a flattening and a little bit downward drift, the way that they did over the past couple of weeks, and where trading volume actually picked up on the way down the past couple of days. We don't want to go in then. We want to wait till they pull back on then lighter and lighter volume, hold at key price support levels, or we get a big increase on any given day, and the trading volume is up substantially. And to wrap this up, not by trying to get in the exactly the right price, but to get in and to allocate to our money to equity securities when there appears to be much less risk losses during the days, weeks, and months ahead. So that's it for this week's Market Insights show. I thank you for watching and listening, and I'll speak with you again next week.